Good evening. Uh, Before I begin to lecture tonight, I want to inform you that we have about 3 more weeks to go into the final exams, into the finishing this class. Make sure that you finish all your assignments. Go back and watch all your videos. Each videos is a point. Make sure that you get points. You accumulate enough points. By now, your average point should be about 4,000, above 4,000. If your average is not above 4,000, you are not going to be able to pass this class. So make sure you are able to do that. Today, I'm going to start with money. I'm going to talk about money, the whole concept of money in economics. And then from there, we move into monetary policies. So I'm going to be talking about money and banking, talk about creation of money, functions of money, and then I will lead that to banks and Federal Reserve banks. So tonight, let me start by definition of money. Money by definition is any item, anything that both buyers and sellers will generally accept in exchange of goods and services. So money is anything that is generally acceptable for the payment of debts and transactions, the buying of goods and services, generally acceptable. There are three major characteristics of money in economics. So when we talk about money, money must have these three characteristics. Number one, unit of account. Our accounting system, for example, in the United States, is based in dollar. So everything we do, wages, prices, rents, interest, all of these are in dollar, the unit of account. Money also serves as a medium of exchange. So when you go to Walmart, you want to buy goods and services, we use money. In the absence of money, then we have to trade goods for goods. In economics, we call that trade by barter. And there are a lot of problems with trade by barter. Example is double coincidence of wants. If I have tomatoes and I want to exchange it for onions, and John has maybe rice, and he needs something else, we cannot exchange. For us to exchange, there must be a double coincidence of wants. So if I need tomatoes, if I have tomatoes and John has onions and John needs tomatoes and so we can exchange. So, so money helps to eliminate that problem. It's a medium at which we can make trade very easily. Store of value, wealth. So for example, most farmers and people, we store their wealth in money. So instead of in material like commodities like wheat or tomatoes, or so they can sell those things and get money and then store it, a store of wealth. So let's talk about money supply, and then we come back the demand for money. So two ways to track the money supply. Number one is called the M1 definition of money supply. Consists of the most liquid assets. M2 consists of M1 plus some less liquid assets. What do we mean by liquid assets, or what do you mean by liquidity? Liquidity is the degree to which an asset can easily be or readily be converted into currency, into cash. So M1 includes demand deposits. What do we mean by that? Traveler's checks. Demand deposits are your checkable accounts, other checkable accounts, traveler's checks, bank drafts. All of these are what we call M1. Cash, traveler's checks, bank draft or banknotes, checkable deposits. All of these are included in M1. And actual currencies. M2 includes everything in M1. We want to broaden it. It's called money aggregate. M1 plus your savings accounts and also your small denomination time deposit like your CD accounts or your retail money funds, your money mutual funds accounts. Now, when we talk about money, we have to talk about the bank, the Federal Reserve Bank. The Federal Reserve Bank is the chief monetary authority of the United States. is nicknamed the Fed. The Federal Reserve Bank consists of 12 regional banks, or what we call Federal Reserve Banks, and they are located in 12 cities, basically Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. All of these are actually called district. There are 12 districts, in the United States. So basically, uh, the one in Dallas is the 11th district. The one in San Francisco is the 12th district. So the Federal Reserve Banks is made up of board, or it's governed by the Board of Governors that oversees the Federal Reserve System. And the board is they have a headquarters in Washington, D.C. The Fed is the central bank of the United States, is the major monetary authority of the United States. The Board of Governors are made up of 7 members appointed by the President, confirmed by the Senate, the Congress. Each board member has 14 years, 2 terms. So let's take a look at what they do at the Fed. Basically, domestic and international financial conditions. They do research on domestic and international financial conditions. They study the health of the US economy and the global economy. And then they also come up with the impact of banking laws and regulations on the economy and other issues that consumers and businesses face. So what are the functions of the Fed, the Federal Reserve Banks? Number one, they conduct monetary policy. I'm going to spend the whole week, next week, talking about monetary policy. They also supervise the activities of other banks, banking supervision, and also they provide financial services. So let me start by talking about monetary policy. Monetary policy is the actions of a country's central bank to influence the amount of money in the economy and the credit in the economy. When there's too much money in the economy, that can lead to inflation. When there's less money in the economy, that can lead to recession. So the goal of the Fed is to direct policies and actions that will control the amount of money in the economy and steer the economy in the always right direction. So the monetary policy is the actions of the country's central bank or the Fed to influence the supply of money and interest rate in the economy. There are basically 3 tools the Fed will use to implement monetary policies. The first one is called the Federal Open Market Operation, or often it's called the discount. Another one is called the discount rate, and the third one is called reserve requirements. So let me start with something we call the Federal Open Market Operations, FOMO. The Federal Open Market Operation, by definition, is the buying and selling of government bonds or securities. Often we call it T-bond or treasury bills in the open market to change the supply of money. For example, if the Fed wants to put more money into the economy, they will buy back the bonds and they will inject more money into the economy. If they want to take money away from the economy, then they will sell the bonds. People buy the bonds and government will get money, and by therefore regulating and controlling the amount of money in circulation. Another method is called the discount rate. The discount rate is the interest rate which the Fed charges other banks when they borrow money from the Fed. The interest rate at which the banks borrow money directly from the Fed, and the Fed controls that interest rate. The last one is called reserve requirement. So each bank must keep certain fraction of their money in a vault as a reserves. So the fraction of checkable deposits that the bank must keep in hands in their vault as reserves, either as currency or on a deposit with the Fed. It's a law. So, for example, if the Fed tells every bank in the United States that they must keep 10% of checkable deposits in their vault, they can't touch it. So if Evans goes to the bank with $100 to be deposited into his account, because the Fed set a rate of 10% required reserves, it means they must keep 10% of that $100 in deposit. They can't touch it. So they will keep $10. 10% of $100 is $10. They will keep that $10 in a vault or with the Fed that cannot be touched for now. The remaining $90, they can loan it out, they can do their activities with that, but that 10% they cannot change. They cannot change that $10. And that rate is used to regulate the amount of money in the economy. And that rate often is set by the Fed. They can increase the rate or decrease the rate, the required reserve. Another role of the Fed is banking supervisions. They supervise the activities of members' banks, identifying banks in troubles. Therefore, they put policy in place to avoid a run on banks. Bank run meaning if a bank is in problem and people descend to withdraw their money, that leads to what is called a bank run, and that can create a whole lot of panic and a whole lot of problem in the economy. They also create regulations to promote a stable banking system in the United States. Another role of the Fed is the financial services. They serve as a clearing house for checks. So, for example, if I'm banking with Chase and I wrote a check to my friend banking with Bank of America, and that guy put the checks into his bank in Bank of America, that checks goes into a clearing system through the Fed and it clears. It settles the account. It clearing checks. Transferring funds. So, for example, you want to transfer money from one account to another account with another bank, it goes through the Fed. Receiving and delivering currencies to banks, managing wire transfers. If you want to transfer money to another country, you want to wire money from one account to another. Performing automated clearing housing services, which I just mentioned. Another role of the Fed is that it serves as the federal government's agent, or what we call fiscal agent. Maintains account for the Department of the Treasury. It pays government bills, processes government checks, postal orders, and US savings bonds, collect federal tax payments. Now let's look at other banks. Basically, banks are businesses. Their goal is to maximize their profit. There are different types of banks, commercial banks, credit unions, investment bankers, mutual banks like Wells Fargo. So banks are businesses, receives depositors' money, make loans to borrowers using depositors' money, move savers' money to borrowers. So they are like a middleman between borrowers and depositors, and bank serves in between. So how does the bank system works? In the United States, we have something called a fractional reserves banking system. It's a banking system in which banks have to keep only a fraction of checkable deposits on hand and the rest available for withdrawal. So, for example, if you take $100 to the bank and you deposit your money, the banks will set aside a fraction of that money. Is called reserves. That reserve is set by the Fed. So it's a requirement by the Fed. It's called reserves requirement. It's the fractions of the checkable deposits that banks must keep on hand as reserves, either as currency or as a deposit with the Fed. So here is the required reserves. deposits multiplied by the required reserve. So let's take a look at this, the rate. Let's determine a bank's required reserve. If the reserve requirement is 22% and the bank has a deposit of 20,000. So what is 20% of 20,000? So you do that. 20% is 0.2 multiplied by 20,000. So the bank cannot touch this 4,000. They have to keep that in a lock box or in a vault. Now, the remaining 16,000 is called excess reserve. They can loan that out. They can use that for loans or other things. So the excess reserve, in this case, the 16,000, is the amount of the reserves that a bank can lend out to earn interest, equals to reserves minus the required reserves. So in this case, you can say excess reserve is the total reserves minus required reserves. So let's take a look at fractional reserve banking. So let's say these are the money comes into a bank, and the total money into a bank originally it's $1,000. Now let's say the reserve ratio, the required reserve is 20%. So it means that banks must keep $200. $200 in reserves, but the other $800 they can use it to lend money to borrowers, and then they can earn interest, and then they can use that for their daily activities. So I want to talk about something called money multiplier. The money multiplier is an increase in reserves in the banking system, which generally leads to an even larger increase in the money supply. So what I mean is that, so if you deposit, say for example, $100 into a bank, and the bank will keep, let's say 10%, 10% of $100 is $10. So now the bank has $90 that they can lend out to people, and now they created a new money, that $90. So you bring in $100 to the bank is creating a $90, and $90 again, somebody brings in the money, maybe $90 to the bank can create 80, and that is called money multiplier. An increase in reserves in the banking system will generally lead to an even greater increase in the money supply. With more excess on hand, banks will have additional excess reserves and will make more loans. When banks make more loans, they create even new money or more money into the economy. So in economics, money multiplier is 1 over the required reserve ratio, or the reciprocal of the reserve ratio. So for example, let's see what happened. If the Fed decided to change the required reserve from 20% to 25%, let's see what happened. The multiplier will change. So if it is 20%, that means for each additional dollar, it generates $5. Now, if they change the reserve ratio to 0.25, that means that is 4. It has gone down. So for every $1 somebody brings to the banks, it generates another $4. So how does a change in the money multiplier affect the money supply? We can see here, when the reserve ratio increases, the multiplier goes down, and therefore the amount of money in the economy goes down. So look at that, change in money supply. Look at that. So it changes based on this, the changes in reserves. Now, let's talk about money demand, the demand for money. What is interest rate first? You forgo interest earnings when you hold money with you. When you keep money, then you are not going to earn interest. When you put money in the bank, then you earn interest. Interest is the cost of capital. So those interest earnings are the opportunity cost of capital. You can think of interest rate as the price of money, the cost of money. If you borrow somebody else's money, the interest rate is the price you will have to pay to use that money. So the demand for money means why people withhold money. Money is often withheld for two reasons. Number one, for transaction. We call it transaction demand for money to buy goods and services for your daily transactions. So we have some money in our account to use for that. Also to buy assets, to hold money as a form of savings for future. So assets demand for money. When you buy a house or properties, you're holding assets. You demand for money to hold those assets. So transaction demand for money is independent of interest rate. No matter what the interest rate is, we still need certain levels of money, at least for our daily upkeep, for feeding, for buying goods and services. So no matter what the interest rate, we still have to have this. Now, the assets demand for money is inversely related to the interest rate. The higher the interest rate, the lower money demand for assets. I mean, the interest rate is way too high. But when the interest rate goes down, people begins to buy more houses because the cost of capital is low. So you can see the demand is downward sloping. So overall demand for money, if you add all of them together, is downward sloping. The demand for money is downward sloping. So if you bring the money demand curve, that is the money supply. The interest rate again helps us to make decisions about savings or borrowing. It comes from the interactions of those involved in the market for money. That is, the interactions of supply and demand. So this is the market, for example. This is the supply of money and the demand for money. So we have equilibrium interest rate. So let's see market dynamics, what happened in the markets. Case number one, what happened if, for example, the supply of money decreases? So when the supply of money decreases, there is a shortage of money, and therefore the interest rate goes up. So that is one case. If there is less money, then the interest rate goes up. Now, vice versa, of course, if there is increase in supply of money, that means there will be new money, surplus of money, and therefore the interest rate will go down. Another one is if there is an increase in the demand for money. For example, people are demanding money to buy stuff, to buy houses, to buy assets. Then, of course, interest rate will go up, increase in demand for money, because there is few money. The supply of money is still the same. Interest rate will definitely go up. You can see, because the supply is the same. So we have the demand is outweighing supply, so the interest rate goes up. So interest rate and assets demand. Two assets, for example, money and bonds. So let's say, for example, money. Money is very liquid. If you have your money, no interest, it's safe to keep your money. But if you buy bonds or stocks, for example, these things are risky. So you need to get some interest. So if you put money in the bank, for example, it's not going to yield much interest. That's why if you put money in your savings or checking account, it barely grows because it's safe. But when you begin to buy assets like bonds, for example, if you are taking risk. So for you to take risk, then you must pay me for that. And that is why we have interest. So let's see what happened in the money market. There's too much money in the market. You can see there's increase in the money in the market supply, then the interest rate will fall. You can see the interest rate will fall. The new interest rate will fall. Let's see what happened in the bond market. In the bond market, when there is demand for money, increase in the demand for money, people want to buy more bonds, or people are demanding to buy assets, then the interest rate will definitely go up. So finally, I want to talk about Fisher equations. Fisher equations tells us that there is a relationship between a dollar today and a dollar in the future. Can anybody tell me in this class, what is the relationship between $1 today and $1 in the or $1 10 years ago? What is the relationship between a dollar today and a dollar 10 years ago? Anybody? Which one is more?
Depreciating.
Thank you. So a dollar today worth more than a dollar in the future because of inflation. A dollar today, worth more than a dollar in the future. A dollar 10 years ago worth more because of inflation. Prices have gone up. So when we look at that, when somebody is borrowing or somebody is lending money, they look at inflation rate. So first of all, let's talk about nominal rate. When we talk about nominal rate, for example, how many dollars a borrower must repay a lender for each dollar borrowed? Now, the real interest rate is how much more or less the lender can buy once he or she is repaid. So, for example, if I come to you 5 years ago, you're my friend, and I borrowed $10 from you, let's say 5 years ago. And today I come up with $11. So I borrow $10. I'm paying you back your $10 for one, so you get $11. You can see that $11 compared to $10 I gave you 5 years ago cannot even buy. So the $1 you gave me as interest is far low. So the real interest rate though, so the way people normally do it, the interest rate is the real rate plus inflation. You have to add some inflation premium there. So the nominal rate is the real rate plus inflation rate. You have to guide yourself. Most banks will add inflation rate because they know that prices goes up by 20% every year. I'm sorry, by 2% every year. So if I try to borrow you, if I try to lend you uh, uh, maybe $20 today, and the real rate, for example, it's 3%. But because I know that every year prices goes up by 2%, so the rate I'm going to charge you is 5%. So that is called the nominal rate. The nominal rate equals the real rate plus the inflation rate. Okay, this is where I'm going to stop. And next week, I'm going to be on campus. I'm going to go through inflation. I'm going to go through monetary policy. And I'm also going to go through some of these things that I've mentioned. Tonight, I want to talk to certain people. Guys, I want you to pay attention. All of you are doing well. Two things I want you to do for me. By next week, when I come back by next week, I'm coming on campus. I want you to be able to finish all of your assignments from, by now, your grade supposed to be above 4,000. If it is not 4,000, you cannot pass this class. And the reason why it's below 4,000 is because a lot of you have not been doing, some of you rather, has not been doing your assignments.